Welcome back. The OPEC Plus oil cartel announced a cut to production quotas on Monday, but the resulting rally in oil prices has been short-lived. West Texas Intermediate crude oil is trading higher this morning at about $86.50 U.S. per barrel, less than before the cut was announced, however. The production cut was small, only 100,000 barrels of oil per day, and persistent concerns about virus-related shutdowns in China have made the market worried about the near-term future of oil demand. Let's take a closer look at some of the details, and we'll bring in our guest, Andrew Lipow. He's president of Lipow Oil Associates. He joins us now from Houston, Texas. Andrew, thanks a lot for joining us. You have described the OPEC Plus cartel cut to production quotas as minimal. So have other OPEC Plus watchers. What is OPEC Plus really trying to do here by making a production cut, which is really immaterial?
Well, they're really trying to talk up the price in response to the fact that, as you mentioned, there's been COVID lockdowns in China, and the high energy prices in Europe are causing industry to slow down and in some case shut. And the fears of a recession in Europe that might spread around the world are worrying OPEC that the demand for their oil is going to go down.
You've also referred to this as a political statement intended to deliver a snub to President Joe Biden and the European Union as well.
Well, that's right, because OPEC Plus could have increased their production to temper the rise in oil prices that we saw earlier this year, and especially after President Biden traveled to the Middle East. We saw a very paltry 100,000 barrel a day increase in September, which was just reversed. So OPEC Plus is clearly going its own way, trying to monetize their oil in advance of worries that the demand is going to go down in the near term.
There are always a range of factors out there that could affect oil in the near term. You're watching Libya in that regard.
Well, right. There's a number of things that are impacting oil prices. We've seen that there's fighting between the two rival political factions in Libya, and Libyan oil production can swing by 1 million barrels a day if production is shut in or there's stoppages at the ports. In addition, we're still waiting to see if the United States and Iran will agree to a nuclear agreement that would allow more oil to reach the market. And finally, we have still sanctions by the United States on Venezuela, which is preventing Venezuela from accessing the oil market and increasing production.
The oil market bulls, which include the two energy sector portfolio managers that remain in this country, say that longer term, the supply-demand fundamentals for crude oil are very positive, i.e. they point to higher prices. Do you agree?
Well, I think what we've seen is we need $90 a barrel of WTI in order to encourage drilling. A couple of years ago, when WTI was $60 a barrel, we saw record production here in the United States, but the investors were not getting a return on their money. There's going to be continued oil demand growth in Asia as well as Latin America and Africa, and that's what's kind of driving these sentiments of higher prices.
We're into September now, and it won't be long before we're in the colder weather months. I know you're watching the European situation. So are market watchers and investors around the world. We spoke with a Bloomberg News reporter this morning who reiterated the notion that natural gas rationing is a real possibility in Europe this coming fall and winter. What is your read on the European situation?
Well, I think the European situation is quite difficult because Russia is now wanting Western sanctions to be relieved in return for restoring production on Nord Stream 1. And I don't think that's a likely outcome. So Europe is going to have to make do with alternative supplies, which includes LNG from the United States and other locations around the world. And we do see Europe is rushing to complete infrastructure to allow those additional imports. At the same time, governments as well as the EU are looking to aid the consumer with packages to temper the rise in electricity and natural gas prices. But it is going to be a difficult winter for the European Union, but you do see them going through this bitter divorce with Russia on energy supplies. And things are going to be quite different in 3 to 4 years.
What is the near-term future of the Nord Stream 1 pipeline? Gazprom, the Russian energy company that runs the pipeline, recently took the pipeline down for maintenance. There's been a great deal of skepticism as to whether that's a legitimate assertion or not.
Well, I think that their excuses really strain credibility because there are 8 compressors that service the Nord Stream 1 pipeline. Gazprom and the Russian government have been arguing with Siemens Energy in Germany about the repairs to a single turbine. So the question is maintenance so poor on Nord Stream 1 that all of these 8 compressors are out of service? But I think that Russia clearly is weaponizing energy against the European Union as they are supporting the Ukraine in their battle against Russia.
Why don't we finish with North American natural gas, still priced much, much higher than it was a couple of years ago. What are the fundamentals driving the North American nat gas market?
Well, really, it's the hot temperatures that we've seen across North America are encouraging additional electricity generation to meet the air conditioning demands. And as a result, we haven't seen the normal storage increases at this time of year in anticipation of the winter. And as a result, natural gas prices have risen. And that's also compounded by the effect of exporting additional quantities to Europe.